Welcome to the Gray Report. I'm your host, Spencer Gray. And whether you're a multifamily investor, active, passive, you're someone that's in the industry, you're in the right spot. Because every single week on the Gray Report, we're breaking down all the latest research reports, kind of articles, data points, and talking to some of the smartest minds in the multifamily industry. We've got a special episode today talking with Paul Fiorilla, the director of research from Yardi Matrix. He's incredibly close to the source, and not only this data, narratives, and also the analysis on the multifamily industry, commercial real estate. Incredibly excited to have him on the report to hear what he has to say about multifamily, where we've been, where we're going, and again, to try to understand some of the nuance when we're talking about the commercial real estate market and the macroeconomy. Well, without further ado, let's just get into it. All right, welcome back to the Gray Report. Paul Fiorilla, Director of Research from Yardi Matrix. Pleasure having you back on the Gray Report. How you doing, Paul?
Great. It's good to be here. It's good to be back, to be doing it again. But, you said, you're talking to the smartest minds. Is there another guest?
He's on next. No, I'm kidding. Paul, I follow what you write on LinkedIn. We were just talking about before we kind of jumped in and pressed record. I feel like your voice is often a voice of, relative reason, as we hear a lot of comments, not only from folks that are inside commercial real estate or just real estate in general, but a lot of opinions from kind of the financial media, as well as just other voices from the media that may not fully understand some of the nuance of, the broad category that is commercial real estate. They can encompass so many different kind of sub-asset classes. So just jumping in, I want to talk about, CRE distress. There's been so much talk about distress in commercial real estate over the last really 18 months. And it's true. Valuations are down. We are seeing some high profile foreclosures. There's definitely stress in the market, not really seeing the systemic distress, but it means that there's a lot of nuance that's getting lost in the conversation. So where do you see, Paul, that the mainstream kind of financial media, what are they missing in the conversation?
Well, in my opinion, they're missing a lot of things. And as you know, because we've talked before, I've been consistent this whole cycle saying, I see an increase in distress, but I don't think that we're at another GFC type situation. I don't see the banking sector crashing because of commercial real estate. So one of the things that, one of the problem type stories that you see is, that you see commercial real estate all lumped into one bucket. And, commercial real estate is not a monolith, right? Clearly the office sector has its own problems right now. But the other property sectors, fundamental performance is pretty good. You look at multifamily, industrial, storage, data centers, a lot of the niche sectors. It's just not a story of poor performance. Even retail, which does have, some distress with regional malls that are kind of obsolete. But the vast majority of retail is, occupied. Rents aren't going up like they are, say, in industrial or multifamily, but they've been pretty consistent. So, for one thing, commercial real estate is not just a monolith. And then, when they're talking about mortgage distress, they lump all mortgage debt into a bucket in the same way, when, all mortgage debt is not the same. When you look at, the lender type, the maturity term, loans that have different investment strategies. You have short-term loans that are on value-add properties. You have long-term loans on stable properties. You have the GSEs. I saw something on the, I think it was Twitter or somewhere the other day, where somebody's like, "Oh, there's this big increase in GSE loan delinquencies."
Yeah,
and it went up from 0.28% to 0.44%. I don't think
they say that a 40% increase.
So yeah, it's a 40% increase. But at the same time, any sector where the defaults are less than half of 1 percentage point, that's, you got to put that in perspective. And then, there's also the stories where they throw out the big numbers. Oh no, there's $1 trillion of loans maturing. But, not all of those loans are going to default, right? So you have the number of loans that default. And then you have the other category, or the other key element of distress, which is loan severity. So if you have, let's say, $1 trillion of loans, even if 10% of them defaulted, you have loans on $100 billion, $100 billion worth of loans that are delinquent. But that's not the actual amount of loss that's suffered, right? So, and then when you look at it, all right, of that 100 billion, how much of it is incurred by the property owner, the equity component? Probably in this cycle, it's most, again, except for office, most, if we're just talking about multifamily, most of the losses will be incurred by the equity holders. The amount of there will be some losses, that banks will take, but that's a smaller component still. So when you start at, oh no, there's $1 trillion of loans maturing, and when you get to the actual, losses suffered by banks, it'll be a much smaller number. And when you look at the size of the banking sector, it's really kind of a drop in the bucket compared to what would be needed to create a systemic crisis, like the GFC, when you had Lehman Brothers and Wachovia, and you had really huge institutions, become insolvent over a very short period of time. Now you have, mostly, small banks that have, exposures to real estate, and they're working through it. And, small, medium-sized banks, there probably will be some that, because of the idiosyncrasies of their portfolios and strategies, that will suffer, problems, and even some banks that go out of business. But it's, not nearly a systemic thing. Yeah.
I mean, banks, unfortunately, they if you look back through history, banks do fail, and banks have gone out of business, and there's been a history of consolidation. It doesn't mean the entire economy, implodes and collapses, but it's much more isolated. And it seems like, we have better tools at our disposal, especially, in willingness, I think, to act at the Federal Reserve to kind of prevent some of those situations from actually unfolding. I mean, it seems like we were able to kind of stop the leaking from the entire system last year, or when we had a regional banking crisis and SVB and First Republic. So it's kind of your opinion that some of this,
and that's another big thing. Just to, the fact that the economy is strong, comparing it to 2008, where we had a very steep recession and a very slow, long recovery. We had, 4.9% GDP growth in the third quarter, 3.3% in the fourth quarter. For the year, it was, almost 3%. So we don't have the same economic conditions that created past crises. And as long as the economy remains relatively strong, that will mitigate a lot of the distress.
And so how do you see, and we don't have a crystal ball, but how do you see this playing out? Because, it may not lead to, a complete collapse, but we've seen valuations, resetting, and that's probably more to do with kind of risk-free rates rather than, concerns with loans and the anticipation of just, properties, being fire sailed. But if this is going to be kind of more or less rolling at, maybe I wouldn't call it an orderly pace, but somewhat controlled, how do you see this playing out? Especially even going away from multifamily, on the office sector, you have these leases that are expiring, but they're not all expiring, this year in 2024. It's a multi-year period where these leases have to reset. Are we looking at just a kind of a slow burn over the next couple of years as this plays out, rather than a kind of a concentrated crisis?
Yes. And again, office it's in its own world, because, as I said, office has its own fundamental problems. Plus, it has kind of a liquidity problem. Banks, investors do not want to add exposures to offices. So offices can't be sold unless, for the most part, they can't be sold unless there's a type of a fire sale.
Yeah.
And, if you're taking out a mortgage, a bank will do it. Not every bank, but the banks that will do it, the private, the private equity funds that'll lend on offices, rates are high, leverage is low. So
Yeah, there's just not the capital. Yeah.
office has its own set of problems. But if we're talking about multifamily and other asset types, yeah, it's going to be a slow burn. And right now, again, you see stories saying, hey, we haven't seen, we haven't seen the big increase in maturities. You get the CMBS delinquency rate. It's going up, but it's kind of creeping up. And a lot of loans are getting extended. I think that's banks don't want to own properties. And I think if property owners want to hold on to the properties, banks are willing to work with them as long as the property is performing well. And, multifamily, nationally, the occupancy rate is, 94.5% according to Yardi's data. So there's good property performance. And as long as properties have income and the economy is okay, I think the first, instinct of the bank and the borrower is, hey, let's see what we can do. So then you have a negotiation. All right, we'll extend the loan for a year, maybe 2 years. And that's what we've seen a lot of. There's money out there looking for distress, and it just can't get spent. So there are a handful of properties, and again, we've seen stories about those. There are some properties that are either in, locations that are, one of the kind of the few locations that are having property fundamental problems, like San Francisco. You've seen some issues with New York City, rent stabilized,
issues,
where rent stabilized properties that have their own sets of problems. So there will be a slow burn over a couple of years if the economy continues to perform well. If rates come down, I mean, depending on what happens with rates and the economy, at the end of that time, you could see, all right, then the loans will get refinanced, or you could even see further extensions down the road. I think, if the borrower wants to keep the property, there's going to be room to negotiate. Where even in the office sector, a lot of the high profile loan defaults have been, the Blackstones, the Brookfields, that just say, hey, they make a decision. Hey, we don't want this property anymore. We're just going to cut it loose. Yeah. And in other property sectors, I don't think there's as much of that going on. I look at the GFC, and when the situation was so much worse for property performance, for the economy, and there was a lot of money raised at the beginning of that cycle that just never, a lot of money raised for distress that just never got spent because the problems got pushed off, and eventually the market recovered, and banks were able to get through that over the course of a few years. And I think, the alternative for banks is, let's say, what happened during the S&L crisis, which is kind of the beginning of our modern real estate market, where, loans got securitized, and that's where a lot of the veteran people in their market got their started. And, the banks failed. They cut their losses, and the buyers became billionaires, essentially.
Yeah.
And I think banks are like, hey, wait, we don't want to do that, right? That's not. We want to stay in business. We don't want to lose all that money. Let's try and
I think that's the key, is kind of perpetuating, as close to normalcy as possible, staying in business. These borrowers are their clients. They have relationships with them. They would like to lend to them in the future. And foreclosing on your client isn't necessarily the best business development strategy, especially when there's a lot of good fundamental reasons to believe that the asset is still, fundamentally sound condition. It's just, if you're dealing with just an increase in interest rates, well, the consensus from, most banks and kind of observers is, okay, well, we should see some relief from rates, over the next, who knows when it is, whether it's the end of this year or going into next year. But that's giving a strong glimpse of hope to a lot of these lenders that, we just need some time to get past this, that we can, a combination of growing our way out of it as well as rates coming down. Why start to market all of the assets that are on our books, ruin relationships, and we can just give ourselves a little bit of time. Now, I guess the question comes.
And the Fed has told the banks you don't have to mark to market.
Yeah,
so that,
they've been very explicit on their guidance.
and
Yeah. And so I guess, I keep thinking about, at some point, at some point, can you extend you can't extend any further until everyone is forced to actually make some hard decisions. But it seems like that's further and further out. As long as there's some hope that rates are going to come down within time, I don't think we're going to have any of those conversations.
there will be there is an increase in distress, and there will be distress in multifamily, but I think it will be concentrated in kind of the cohort of properties that were bought and sold, the value add properties that were bought at very low cap rates with very low loan rates, high leverage, financed maybe short term through the CLO market. There were $28 billion of multifamily CLOs issued, or CLOs issued backed by multifamily properties in the year 2021, which was the single greatest year in the history of the CLO market.
Yeah.
And that was just before rates went up. So you had, this cohort of properties that was financed, with short-term strategies. It's kind of like, hey, we're going to turn around and flip it, because, that was a very successful strategy over the last decade or so, to buy value-add properties, as rents are going up, turn around and flip them in a year or two. And there were a lot of properties, several thousand properties in our database that were sold multiple times during that 10-year period between, say, 2013 and 2023. And that cohort of loans, that's where I think the distress is going to be concentrated, or that cohort of, strategy.
Yeah.
And that gets to, people who were very aggressive about buying properties, looking at multifamily as a short-term investment. And I think, multifamily is more properly operated as kind of a long-term strategy. And if you do play that, short-term, buy and flip game, if you're caught when the market turns, it's like playing, right?
Yeah, the music stuff. And it's a difference.
You're okay until you're the one that's, not when the music stops and you
no
don't
more
have a chair.
Yeah. And that definitely seems where the concentration of distress is right now, because not only did you have buyers making assumptions that included cap rates staying sub 4%, but you also had buyers that were anticipating double-digit rent growth for future years, including a premium on the renovation that they would execute. The cost of renovation have increased. And then on the flip side of all of this, as they're delivering, you have a record amount of supply that starts to come online in the market as well. That is, albeit most likely a short-term headwind for the market, kind of probably throughout 2025, early 2026. If you have a 2 to 3 year bridge loan that was originated in, 2022, well, the time's coming up, you can get an extension, but you're still, delivering in a range where the fundamentals are challenged from at least your kind of entry and exit point from a basis standpoint, as well as rent levels. Because as you've seen and Yardi Matrix has been detailing, we're seeing a record amount of supply coming online nationally. I think we're at a kind of 40-year high in deliveries in 2024, which is
tracking 1.2 million,
1.2 million
properties under construction right now. So our forecast for deliveries over the next 2 years through 24, 25. It's about 550,000 this year, about 460,000 next year. And that's just, finishing the loop on, the properties that have already started.
Yeah.
And after that, our the delivery levels go down in starting in 26, 27, down to like 350 to 400,000, which is not nothing, but it's,
I was going to say,
significantly less.
that kind of just gets us back to pre-pandemic levels, maybe a little bit under, because we were delivering
Yeah.
kind of mid 300,000s. I think back in 2018, 2019, we were pushing like 400,000, and those are some kind of record-setting years. So it's certainly a change from the 500,000 units that we're delivering this year and close to next year. But it's not it's not to say that supply is going to go to zero, because people are still trying to get projects done. Do you think that number could change, that the delivery number in 2026? Do you think that there's some play in that? I know I was at an NMHC, and I saw the presentation between Jay Parsons and I think Jeff Adler, the CEO of Yardi, talking about some of the differing opinions in the data. And Yardi
Right.
and RealPage, you guys have some of the best data sources, because you both obviously are getting real information from actual properties. Do you have any opinion or thoughts on what that supply number could look like, or what's the variables and what's the play looking towards 2026 and onward?
Well, the interest rates and what happens in the banking sector will determine the exact levels of the decline in deliveries over the next few years. It's hard to project too many years into the future, but I think our forecast calls for deliveries to decline, but not quite as much as other forecasts. Some, you mentioned RealPage. I think they're expecting deliveries to drop a little bit more than we do. But
Only time will tell.
if construction costs remain high, that will impact the level of deliveries. But I also think that there's a long-term housing shortage, and there's efforts we need, and that's kind of one of the got this struggle, this tension between needing supply, because we kind of housing after 2008 kind of slumped to record lows. So we went 6-7 years under building, and that the gap between demand and supply built up over time. So we're just trying to kind of we're still trying to make up that gap, and we're still not there yet. And that's why rents have gone up so much. I mean, over the last 10 years, according to our data, the average rent growth in multifamily nationally is like 4.6%. Now, the long-term average is more like 2.6, 2.7%.
Yeah.
So the rent growth over the last 10 years has been so much more than historical levels. And a lot of that is because we underbuilt for a long time. And so the concern right now, I mean, the big concern in the market, is with the Sun Belt. So you have a short-term, the drop in rents. And a lot of that is caused because that's where supply, right? I talk about, 1.2 million units under construction, but they're heavily
concentrated.
In, places like Austin and Charlotte and Nashville and Phoenix and Denver and places in Orlando. And so you have these markets that have really super high construction as a percentage of stock. And there's concern about that. But, those markets, when you look at, those markets have grown faster in terms of population and job growth for decades. So I don't think it makes sense to look at multifamily and think of short term, because it'll take a couple of years, and I think rent growth will be slow in those markets for a couple of years. But I think long term, they'll be fine, and because we definitely need the housing stock to support the country. And in fact, I also think that if you don't build enough housing, you won't have, metros that wait and postpone housing development and put it off and try and suppress it. You're actually stifling economic development because
Yeah.
companies looking for somewhere to locate are going to say, hey, there's nowhere for our workers to live, and they're looking for places that employees want to be.
If you have to commute an hour in from where you live to where you work, I mean, that over the long term, I mean, that starts to break down, the fabric and the makeup of a city and the culture of the city. And you're seeing it, on markets like in San Francisco or other, kind of California or West Coast markets where it's incredibly unaffordable. I saw even with some of the rent declines that San Francisco has seen over the last couple of years, still the difference between, and I saw this on some of the Yardi data they did share with us, but the difference between renting in San Francisco and buying, I think, is still like $7,000, per month difference. And and it's stark across the country, but you can't afford to live in San Francisco proper or any of these cities that are so a huge barrier to entry. And it's primarily, they're beautiful places to live, but so much of it is because of regulatory concerns and the lack of development and the lack of investment over time. And I'm curious, we had some interesting data now over this year and last couple of years, and 2024 and 2025 as well, looking at the impact of market rate development on markets affecting affordability. Certainly, affordability is close to an all-time kind of low right now, kind of tapping out on a national average. I think the Yardi number puts it kind of right below 30%. Yeah. But we are seeing rents in even workforce housing and B-class apartment communities even come down in some metros that are seeing quite a bit of supply. And it's not as though those markets are seeing, new Class B or Class C.
Right.
They build that. It's from the new market rate units having to lower their rents, and they're trickling through the ecosystem. Curious of your thoughts on the effect of supply on rents, affordability, and trying to prove that.
Before I forget, I just wanted to say, when you talk about the cost of single family housing, I think construction has been constrained even more than multifamily housing. Because single family developers react a lot more quickly to market conditions, and a lot of them are smaller local players that don't have access or can't, to construction financing, or can't afford, based on the higher construction loan rates. So one of the reasons why, one of the benefits of multifamily is that, it's still right now, it's like you said, record less expensive compared to single family housing. That's keeping people in rentals that otherwise might have, bought single family homes in the past. But when you talk about market rate versus affordable, I'm of the opinion that we need every kind of housing, right? I mean, if we can build market rate, great. We build as much of that as makes sense. We also need, to build affordable, because when you look at talking about the rent to income ratios, they're going up. It's how the cost of housing is going up. Even though wage growth has been strong in recent years, it hasn't gone up nearly as much as the cost of housing over the last, 5-10 years. But also, when I look at rent to income ratios, when you talk about averages, it kind of, it's interesting, but it also has less meaning, because the problem with affordability has been and will be concentrated at the lower end. So, whatever the average is, it tells a little bit of a story, but really it's a problem on the lower end of the scale.
Yeah.
And that's why we need market rate housing, but we also need to, we need, policy and government to help in that regard. So that involves, subsidies. Oops, I lost my mic. Oh, sorry. My mic cuts out every once in a while. So we need housing subsidies. So tell me if my mic has gone off, but
I think you're still good. There was a little bit of a change, but you're good.
sorry about that.
I think it's still.
So in the most recent negotiations between the House and the Senate, they passed a bill which would um, increase subsidies for housing. Plus, you need incentives like LIHTC and tax breaks for developers that build affordable housing. And I think you also need direct renter subsidies like Section 8. And I think there was a proposal for like 250 billion of funding for all those kind of things that was taken out of the Inflation Reduction Act a couple of years ago. And that's unfortunate because all those things are needed, and I think there's bipartisan agreement that those things are good. However, it's kind of being held up by the political situation in between the House and the Senate right now. So
yeah, it's too bad. That would have been one of the actual contributors of actually maybe lowering inflation.
Yeah, and I guess it's still a possibility, but right now, it's kind of hung up. But
is there anything on I've heard a lot of talk about the middle income housing tax credit, kind of like an idea of a MITEC, right, in addition to LIHTC. Or anything of that kind of concept gaining momentum, just on the statement of we just need to build more housing, and it's the lower end of the spectrum of the income demographic spectrum, but there's a lot of folks that are just kind of outside of that are also relatively housing burdened, especially in certain metros.
Yeah, I don't know if
it's going to get anywhere.
I think that I mean, it's a good idea, but I think that'd be kind of a tough sell. I mean, right now
you can't get LIHTC passed.
Right now, you have the Senate and the House in different parties, and you've got a lot of personalities involved that you got sort of some elements that don't want anything to be passed because they don't want anything to look, they don't want anybody
to make the other side look good, or
they don't want Biden to be able to say, oh, we passed something. So they're just kind of holding everything up. And if there's any bipartisan legislation, then the kind of the extreme, like a Tea Party or whatever they're called these days, will try and depose the speaker because they don't want the speaker to do anything with that has any cooperation with Democrats. So that's why McCarthy got voted out of the speaker, and Johnson has the same pressure that if
he's having challenges as well. Same problems. Hard to get
right
done in an election year. Good luck.
Yeah. So if he passes bipartisan legislation, he'll wind up getting deposed as speaker, or at least the chance of that happening. So I think that makes it very difficult to pass even legislation that most everybody wants.
So that's a really good segue for the next question I wanted to ask you about. So another piece of legislation that's died recently in Congress is immigration reform. And so I wasn't going to ask about immigration reform, but rather the effect on immigration to the housing market, specifically multifamily. And there's no politics in this question. It's just, we've had an increase in immigration, legal and illegal. There's more people that are coming to the United States, not putting a qualifier on that. It's affecting population growth. One of the negative fundamentals, I guess, for U.S. housing is, declining birth rates, slowing down of population growth. One could argue that a cure not only for the housing market, challenging because we don't have enough housing, but from a macroeconomic standpoint of we don't have enough labor, there are so many jobs that are available, and costs have been rising. And so you need a labor force to do that work to bring costs more in balance. But without a doubt, immigration is having some effect on housing. There's numbers being thrown out of how many people have come to the United States over the last couple of years. 5 million. I've heard of 10 million.
Yeah, well, the Congressional Budget Office put out a piece about 6 weeks ago, I guess by now, which estimated or stated that there were 2.6 million immigrants came into the country in 2022, and about 3 million, 3.2 million in 2023. I might be getting that slightly wrong, but almost 6 million over the last 2 years. And again, with it, whatever one thinks of, whether that's good or bad from a political point of view. And, I mean, my family came here as immigrants at one point, and so
Yeah.
I'm glad that happened. Whatever you think of that, it clearly has had an impact on multifamily demand and demand for housing. Because, you look at, we went through the pandemic, and then in 2021, we had a record year of absorption, apartment absorption, over 600,000 units absorbed. And that came from, all right, there was a migration coming from the coast to the Sun Belt. And then you had, people were splitting up from roommates because they had, the job market rebounded. They had money to spend from their, stimulus checks and so on. Plus, you had people who were living in small apartments. Like, yeah, I'm working from home now. I don't, I need more space. Yeah. You had, people going to the suburbs. You had all sorts of things that were happening that created housing demand. And over the last couple of years, demand has remained really strong. Not at 600,000, but closer to 250 to 3,000, which is kind of like a normal, strong year of demand. And again, because you mentioned, right, the birth rates going down, the natural growth from, domestic sources, the natural growth of population is going down a lot. So where's all this demand coming from? Well, the CBO report, I think, kind of unraveled that mystery. There, we have, first we have a rebound in legal immigration. It was kind of held up by, the last administration policy and the pandemic. So you have a kind of a rebound to sort of normal levels of permanent immigration. You have, rebound in, I guess, the student population, coming back after a couple of, foreign students. Plus you have asylum seekers who are, that's obviously there's a lot of those right now, and they're in the country awaiting hearings. They need somewhere to live while they're waiting. And then you have illegal immigrants. And, the CBO estimated that that it'll add about, I think, $1 trillion to the economy over the next decade. So again, without, whatever you think of, whatever you think of the, the social, cultural impacts, whatever. And I think most of that is overblown.
Yeah.
But it's good for, the housing industry. Plus it fills jobs. I remember how a couple of years ago, how we were talking about, I go to the restaurant and they only had 5 tables open because there was nobody to wait tables. And
I'm still seeing that today, Paul.
Yeah. And multifamily construction, right? There weren't enough people to fill the construction. I mean, I hear this. I was talking to somebody in Boise a couple of weeks ago. I was at a housing conference, and they were saying, there's a huge housing boom up there. There's a big influx in population, and there's a big development, a big corporate development up there that's kind of taking up like every electrician in the whole market, right? Yeah. So all these are working on this like new factory, this new, I think it was a battery plant or something. And, so housing developers don't have enough people to hire. So, the immigrants are filling kind of jobs that, were unfilled. And, it's not like, you think that the backlash, and I probably shouldn't say this, but, like historically, immigration has had periods of backlash, right? That's just a fact. Yeah, but most of the time, the backlash came during times of, where the economy was not good. And people are like, oh, there aren't enough jobs for Americans. Why do immigrants come in? But now you have, there's very little slack, if any slack in the workforce. So, to resent somebody, it's not because they're taking away anybody's job. Put it that way.
Yeah, no, I think some of the detractors, I think, are a little bit more fear-based. I think we're more or less on the same page, but it's interesting because I guess kind of getting back to the kind of the crux of the question from, at Yardi, when you're looking at these markets. Is there a good way to incorporate, that data of immigration, legal and non-legal?
I don't know that we can
and
track like, specifically, who's an immigrant and where they're going, but I
Yeah.
will say that clearly it's had an impact on apartment demand in markets where immigrants tend to settle. So you look at big coastal markets like New York and Los Angeles, or even
Tucson, Arizona has been
Chicago,
blowing
yeah,
up.
Tucson, and like border cities, markets that already have large immigrant populations, and immigrants, you know, go to places where they have other people from their, kind of ethnic group, people who speak their language. And I mean, I live in New Jersey, and it's always been, a very big landing spot for immigrants. And you look at the apartment occupancy rates in northern New Jersey, New York City, it's like 97%.
Yeah.
And it's really strong. And some of that has to do with immigration. They also wind up in places that, again, have jobs, farming, manufacturing jobs, different parts of the country where there are pockets of immigrants. So that's been a big thing. And I think that helped some of the large markets that lost population in 2021. We were talking about that migration. And back then we were looking at that and saw this, huge decrease in occupancy rates in some of these big markets, and saying, gee, it's going to take years to recover. But within 18 months, they had come back and had higher occupancy rates than ever before. And
yeah, New York really seems like it's come back around kind of full swing and much quicker than even San Francisco or other markets. And it's surprising that a lot of northeastern metros and markets and the Midwest, and I think it's this is centered around supply, but just kind of pivoting a little bit, kind of talking about some regional performance. The Northeast has been outperforming. The Midwest has been outperforming. On Yardi Matrix, top 10 markets of rent growth, even over the last 10 years, you see a very different cohort than you would have expected a year or several years ago. It's a lot of Midwestern markets like Kansas City, Indianapolis, but you don't necessarily see the Phoenixes or the Austins. They're on the other side of the sheet on the markets that have actually seen some declines. Some of this is short term relative to all the supply coming online. We mentioned that by 26, 27, it's going to start to slow down. I wanted to ask you, and this is related. I read in one of your pieces, you pulled out a quote from Dallas Fed talking about we're going to tie climate change into this also somehow. But the interesting quote from the Dallas Fed, for every 1 degree an average temperature increase in Texas GDP sees a decrease of GDP of about 0.4%. And so kind of the question is, are we seeing some shifts potentially from investors between regions where they were focused on the gateway markets, then shifted to the Sun Belt? Are we seeing now, I guess, a further, not maybe full shift, but diversification away from the Sun Belt into other markets like the Midwest and elsewhere? I think they were already in the Northeast.
Yeah. So there's a lot of questions here. Remind me to talk about that Dallas Fed, because that's part of a piece I just wrote. But first, let me just answer the last question first. So the core you have the core markets: New York, San Francisco, Chicago, Boston, LA. And for a long time, they were, they attracted all the big institutional, most of the big institutional capital. I worked for Prudential for 6 years, and, they wouldn't invest outside the top 8 or 10 markets. But that's shifted because of, right? So we have, over the last, 10, 15 years, there's been an increasing amount of capital going toward markets that are faster growing. The Dallases, the Seattles, the Nashvilles, the Atlanta. And that was a good investment. And right now you're starting to see a trend where people are worried about the supply growth in the Sun Belt. And I'm hearing a lot of chatter, that people want to go back to kind of what used to be the core markets or even tertiary markets but so I think, there is concern that, growth in these fast growing markets rent growth is going to be affected by the wave of supply. But I think we might be talking so much about that, um, I think over time, those markets still make sense. And if you have, if you're looking at, say, like REITs, and you're thinking about the next quarterly, report, maybe that makes some sense to think that way. But I don't think that's the right way to approach multifamily investing. I think you've got to, you look at the submarket, approach properties that, have solid demand and solid markets. And I generally think that there's strong drivers to recommend pretty much most any region. You have the Northeast, the economy in the North, people. This is kind of interesting because, I'm from the Northeast, as you know, and I've heard people, most of my, decades in this industry, people kind of put it down. But, the economy is doing really well. New Jersey's, actually we have, decent multifamily construction. New York City's economy is strong. People want to live there, even if they don't want to go to the office. There's demand to apartments. So, Boston has, Harvard, MIT, the biotech, and a lot of technology industries, and they also have a shortage of housing. Housing costs up there have gone kind of crazy, especially single family housing.
Well, that's some of the appeal of those gateway primary markets, is that they shouldn't be going anywhere anytime soon. They're going to be around for the next couple of decades.
And the economy, even though they're not growing as fast as the Sun Belt, and they never will probably, but there's enough demand and supply is kept in check. And there's bad parts of that too, but from a rent, they're stable, and you could do well. The Midwest has seen a lot of growth, and so right now, as you pointed out, the Northeast and the Midwest are at the top of, we publish a monthly report and look at the top 30 metros. And for a long time, the Sun Belt markets were Florida, Texas were, way up there. But now for the last 6 months or so, the markets with the highest rent growth are in the Northeast and the Midwest. Like the top 10 is almost entirely comprised of those two regions. And again, the Midwest, they've seen growth, manufacturing, the auto markets, autos rebounded, logistics, education, healthcare. There's a lot of, steady, solid growth, not Texas.
It's not jumping out. Yeah, it's not jumping off the charts. But
the economies are producing jobs, and there are, the population is growing, and they don't have the huge demand, the deliveries, huge amount of deliveries that you have in the Sun Belt. So that's, a consistent, steady kind of investment area. So there's been, there's been kind of a movement toward those parts of the country. But, I don't think it makes sense to spend too much time looking at, the last 6 months or the next 6 months. I mean, you have to look at it, but
it's what's the next 10 years is the way you should.
5 years, at the minimum 3 to 5 years, and the investment horizon. And I think there's a good story to be told in most every region. I mean, there are some markets where, and these are mostly smaller markets. You look at places like Boise or Huntsville, Alabama, or places like that. They're fast growing, but they're also such small markets, and you have 20-25% increase in housing stock just under construction at this very moment. you know,
It's volatile, and it's a lot of
it's volatile.
increases
It's,
and decreases. Yeah,
again, they'll be okay over the really long term, but it'll take them a lot longer to absorb 8,000 units than it will for Austin to absorb, 25,000 units.
yeah. There'll be some growing pains, but the trajectory is pretty clear. So, in addition to supply, because I agree 100%. I think the Sun Belt, the markets that have the good fundamentals are going to keep growing, and it could be a really good opportunity for buyers to acquire assets at a lower valuation in higher growth markets. But you might need to give it more than 2 or 3 years to maybe see some of that growth. But what about we're also seeing rising expenses across the board, no matter what region that you're in. Expenses have gone up. I saw a slide from Yardi around, I think, between from 2021 to 2023, about 15% expense growth. In some markets, just within a year, they've seen 15, 16% rent or expense growth. Insurance has been a major contributing factor across the board, especially in coastal states, the Sun Belt. And it's become unaffordable for a lot of buyers. And so when you're looking at a combination of, your insurance premiums going up, doubling or tripling, plus, rent decline, supplies coming online, interest rates are high. Obviously, it creates a stressful environment.
We did a study based on the data that we get from our software clients. Most Matrix data doesn't come from Yardi software clients, but the what we call our expert data. We compile the expense information from our clients and we aggregate it so it's anonymized, but on a market level. And we found there was a very large increase in expenses. Typically, they go up 3 to 5%, but last year through mid-year, they had gone up like 9%. Total expenses went up about 9%, and that moderated by the end of the year to, I think, about 6%. But insurance just keeps going up and up and up. So in 2023, on a trailing 12-month basis, insurance premiums per multifamily unit nationally went up 20%. And the increase was much higher in places that are affected a lot by storm damage, such as Florida, the entire Southeast. Insurance costs, the whole hurricane region, Alabama, South Carolina, Florida. The insurance costs went up way more than 26%. Some markets, more than 50%. Also went up a lot in other markets, Texas, California, that have weather-related damage events. And Florida has a unique problem because, a lot of the insurers are dropped out. The laws in Florida make it very easy to sue for damages. So I think one of the major insurers said, I was talking, he was speaking at PRIA a few months ago, and said that 80-something% of all the lawsuit payouts that insurance companies pay come from Florida, even though they're only about 10% of the claims. And Ron DeSantis, the governor of Florida, just said that Florida has, for homeowners and for some multifamily, has a state kind of insurer of last resort called Citizens. And DeSantis just said recently that Citizens is insolvent because there's just too many claims relative. Because you raise that money through tax money, and it's limited. And when you talk to people down there, they'll say that not only have premiums gone up, but the amount of coverage decreases, the amount of deductibles increases. So you're paying more and you're getting a lot less coverage. So that's kind of an issue. And now, as of right now, insurance remains a small part of the overall expense picture. They're about 5% of all expenses, 6% of all expenses. But it's growing. If it's growing a lot faster than all the other expenses, and So you
other
mentioned
expenses have increased
reading
as
a
well.
you mentioned
Yeah.
I was just going to say you mentioned reading. I just wrote an article that was published in the Summit Journal, which is a magazine published by the Association of Foreign Investors in Real Estate, AFIRE. And it talks about, will the question that was posed in the piece was, will the increase in expenses in insurance, especially, start to erode the advantage that the low cost housing markets have. People move to Florida and Texas because it's cheaper. At some point, if expenses keep going through the roof, will that advantage be eroded? And these technology, right?
Oh yeah.
Yeah. Um, the Dallas Fed estimated that rising heat impacted the actual GDP of Texas a couple of years ago or last summer when they had that really extreme heat wave.
Yeah.
There's less tourism, people don't go out, all sorts of reasons. And it said that it reduced GDP. So if the heat continues to become more extreme, that situation with less economic growth, higher insurance costs, and so on, that could eventually erode the cost advantage that some of these markets have. Now, I don't think that's going to happen in the next decade or so, but as a long-term thing, it's probably worth keeping an eye on, because the costs associated with weather-related events is growing substantially over the last few years.
Yeah, it doesn't seem to be slowing down. The events seem to be more frequent and more intense. And so whether that's a hurricane or heat, or in Texas, 2 years ago when they had that freezing event, also just kind of the extreme weather when, Houston's not used to, having a freeze. And I think they had a freeze this year earlier. That's landscaping that gets destroyed, water, pipes that get broken.
People didn't have power for, days.
Yeah, it was rough. And so, just again, it begs the question with, expenses are high, but affordability is low. And so it doesn't, costs are up for construction. And so for, a multifamily operator, it begs the question, okay, well, where is this growth going to come from? Can you reduce, expenses? There's been a lot of conversation revolving centralization and utilizing of technology and AI. Any indication when you see that takes more of a predominant role in operations, or how should an operator look over the next few years navigating high expenses, not much opportunity to raise rents? Where do you go?
That's definitely an issue that, because the things you mentioned, rent growth slowing down, and there's a lot of new technologies. Companies like Yardi have developed that help property owners manage more efficiently. That's going to be, a bigger differentiator. And I think that, I also cover the single family. We haven't talked about single family rentals. And it's important in multifamily, but I think it's even more important. It's actually going to be like the big issue in the single family rental market for institutions, because it's a very young industry. It's a very operational management intense industry, especially there are a lot of the big owners have scattered site portfolios. So their biggest cost is managing the maintenance and so on of these properties. So even small improvements in operating efficiency and SFR is going to make a huge increase on the bottom impact on the bottom line. And I think that you read the analysis of Blackstone's acquisition of, I think it's Tricon or whatever.
Yeah.
They just agreed to buy a large operator, and that company's stock portfolio was trailing kind of the industry averages, because they have higher expense costs relative to their peers. But it's definitely you know, buying, the growth that was enabled by low rates, and that helped buy huge portfolios over 2022 and 2021, 22. That has kind of diminished because now the deals don't pencil out as much.
Yeah.
You're paying 6% or 7% for a mortgage as it did when you're paying 3 to 4%. So the growth of the acquisition growth is slowed, and so the growth in institutional SFR is coming through build to rent.
Yeah.
Which is right now there's record like 64,000 units under construction, which isn't a lot compared to multifamily, but it's the most in that sector. And the other important factor for SFR owners will be kind of improving efficiency of management, maintenance, and so on.
Yeah. It's interesting, kind of the concept of, kind of horizontal multifamily, and, what's the best way to manage these single family rental assets, whether that's in more of a build to rent model, you're building or buying a whole subdivision or community, or whether it's more traditional kind of scattered site management. But it's interesting, and we failed to mention a lot of the single family rental space. But what are some of the other differences? I know that the vacancies are a little bit lower in the single family rental space. Any other divergence between single family and multifamily?
The performance, when you look at rents and occupancies, they've kind of moved in tandem. SFR, and we track SFR communities with 50 or more units. So we've got a database with about 300,000 SFR units, that including the development pipeline. So we're not measuring every SFR. We're not measuring scattered site properties.
Yeah.
But the SFR communities have slightly higher occupancy rates than multifamily, and rent growth has held up a little bit more. I think through January, it was about 1.5% compared to 0.5% year over year for multifamily. So its performance is very strong, and I think demand for SFRs will continue to be strong through the foreseeable future, because people want the amenities of single family homes. Not everybody wants to either own a house, they don't want, or they can't afford a house.
Yeah.
Or there's not much inventory at the moment. So there's a lot of reasons, young people who want flexibility to move, older people who are downsizing from, McMansions or whatever, because their kids have left, grown up, and they want something smaller, and they don't want another mortgage because, they're retired.
Yeah.
So
The
to me,
demographics make a lot of sense.
Yeah, to me, there's a huge amount of demand, and will continue to be, for SFR. But at the same time, I think as an institutional sector, the growth potential is somewhat limited by the fact that it takes so much operational expertise to do it.
Yeah,
well.
I don't know. I don't know if anybody's got the blueprint. Maybe somebody does. I know a couple folks that are doing it and doing a really good job at it. But it's not like multifamily where we've kind of been set in our ways for a while. Technology's adapted, and there's been some small changes here, here and there. But we know how to operate, a traditional market rate, large apartment community with on-site staff. But build to rent community, again, I'm sure best practices are being formed and adopted today, but it's a pretty new asset class. But I think all the points you made make a lot of sense. I mean, we're at kind of peak family formation years for millennials, which is the largest kind of demographic cohort. And when you have a family, you're typically looking for some more space, and whether the American dream is the white picket fence with the backyard, or it's the 30-year mortgage, or it could be both of those. But I think it's more of the lifestyle and the amenities rather than the going into debt necessarily in buying the home. And there's not enough housing stock out there, as you mentioned.
Yeah, I think different people want different things at different stages of their life, and I think there'll always be good demand in that sector, and it's still a small sector.
Yeah. It'll be interesting to see how it develops over the next decade or so. Well, Paul, we've taken up a lot of your time. I really appreciate it. Any closing, I guess, remarks, or if you had, what's on the top of your mind, when you're thinking about this, every single day, in your job, you're seeing a ton of data. Any kind of closing remarks to kind of sum up your feeling on the economy and the market?
Yeah, it's just very positive, I guess, on, and kind of strange to think, it's almost like not cool to be positive, but, we've had a couple of years now where pretty much everybody is forecast a recession, and it's always around the corner.
Yep.
And, maybe we're just not going to get one. Maybe all the stimulus policies, were the right thing to do. And, after the GFC, we didn't maybe do enough stimulus. And I think the evidence is now that, you know, keeping people employed, keeping, the economic wheels rolling was a good thing. So I think, the economy is good. I think the multifamily demand will remain good. I don't, again, it's not going to be like 2021 again. We're not going to see another year like that.
Maybe that's a good thing.
Yeah. And I think all the pessimism around, defaults and everything, there will be, but I think generally speaking, there'll be disappointment that we won't have that big of a crash in the market. Some small banks will have failures, but it's not going to be a sector-wide crisis. So I think I think this year it's going to be okay. Now, there's a lot of crazy things in the world, and wars and things that can happen that are hard to foresee. But absent those kind of things, I don't see any reason why we're going to, like the forecast of a recession, like why exactly is that going to happen? There's 3.8% unemployment. People are spending money. Consumer spending is strong, right? So what if you think there's going to be a recession? I've yet to hear a really good reason why suddenly there's going to be one, other than, well,
it's due where it's time.
It's time. We need to be punished for, the government, intervention is a bad thing. And therefore, we're just about to get, we have to pay for our sins and that kind of a thing.
No, I agree with you, Paul. I'm an optimist also. It's a lot more fun, I think, to be an optimist. It doesn't get all the headlines. Not that things can't look scary, but generally things often do work out. Not that there aren't black swans out there and things happen. But I think there's a lot of things to be positive about. The economy is in really good shape. And that's frustrating a lot of people because it doesn't seem like it would. But I agree with you. And I've asked the same question of where I've had people call for a recession in Q1 of 2024. And I've had to remind them, well, we're in Q1 of 2024. And connect the dots of how we get to a recession.
I hear people say things like, "Oh, you know what? Why is there going to be a recession?" And then one thing I'll say is, "Oh, well, look, the federal deficit keeps growing." But where's the evidence in history that is what will cause a deficit? Because my whole life, my adult life, I've been, since I started voting, Reagan Carter, I've been hearing these, dire warnings that, the budget deficit's going to do something to the economy. And none of those, dire warnings, ever come to pass, So at some point you have to think, and again, I mean, you look at other countries with high debt to GDP ratios and, they haven't collapsed and so on and so forth. But, it's a whole nother debate here, but I don't know. I think that a lot of the reasons for pessimism, I don't agree with those. And again, not that something unforeseen isn't going to happen, but I just generally think it'll be, uh, a decent year for the economy and for commercial real estate.
Yeah. Yeah, I agree. People overweight the negative and underweight the what's more likely. Well, Paul, again, really appreciate you coming on the Gray Report. Have to have you come on again soon, maybe in a couple months, see where we are. It's fast moving market. Things change all the time, and your thought leadership is greatly appreciated. So thank you again.
Thank you. It's great to be here.